How's it going, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and welcome back, my degenerates, my dirt bags, my doom scrollers, and closet perma-bears. It's March 28th of 2025, and today we watched the market pull a full-on swan dive off of a cliff. The Dow dropped 710 points. The S&P 500 lost 2% in today's action. And the Nasdaq is down 2.7%, led by an absolute bloodbath in the tech sector. Hope you enjoyed that rally while it lasted, folks. So all you bulls out there who were all happy-go-lucky and giddy about what was going on, it looks like it was not really your day today. All of this is because inflation won't die, tariffs are back like it's 2018, and consumer confidence is circling in the drain. But don't worry, gold's at record highs and AI IPOs are flopping harder than a Netflix original. Let's go ahead and break it all down today to see what exactly happened in the market. Now, first things first, President Trump is pressing the tariff nuke button again. 25% levies on foreign-made autos, with some retaliation expected April 2nd. Wall Street reacted how you'd expect. Sheer panic, followed by apathy, followed by, well, more panic, folks. And Canada and EU were warned they'll get hit with even larger tariffs if they link up against the US. So yeah, you could say global trade relations are an absolute dumpster fire, like that relationship with your ex-girlfriend that you said would never affect you. Now, we did have PCE today, and that thing came in hotter than two butt cheeks stuck together in a sauna, folks. We had a 0.4% month over month versus the 0.3% estimated, and we had 2.8% month year over year, which we are stuck at, and our Fed target is 2%, mind you. So do with that information as you will. Basically, Powell's transitory narrative is aging like milk that you forgot was in the back of your fridge. You just open it one day and that will smell. That will smell, brother. Now, the Atlanta Fed's GDP Now model / Q1 growth from 1.8% to minus 2.8%. That's not a soft landing. That is like being on that Delta plane that just completely flipped over when it hit the tarmac and you were offered $30K to never sue and act like it never happened. Yeah, we're looking in for a hard landing with no wheels here, folks. And it gets even worse because the University of Michigan consumer sentiment dropped to 57. Yeah, that's the lowest level since November of 2002. 2/3 of people think unemployment is going up, and no surprise, retail stocks are absolutely vomiting like that one girl that would have to go to the bathroom way too often in high school. Now let's talk about our options flow bloodbath that we saw today in the markets. We had SPY with 72 million in flow, with 10 million in calls against 61 million in puts. 8 separate blocks went in today, and they were mostly around the $555 range. And that is not hedging, folks. That is just straight up anticipating more downside and falling within the market. And QQQ, if you think it was spared, it was not, my friends. We had 44 million in total flow, with only 8 million in calls against, well, you can guess the rest, 35.9 million in total puts. And we had a big $10 million bet on the $470 puts expiring on April 5th. So the Qs are the epicenter of this correction, folks. And IWM saw 37.6 million in total flow, with 5 million in calls against 32 million in puts. And add in the Lululemon warning, by the way. Yeah, that tracks, because Lululemon was getting destroyed. Tesla and Nvidia both were not safe. Tesla's still acting like that favorite game in the casino, with only about $900,000 separating them from their total flow. But Nvidia was not spared with 14 million in puts against 10 million in calls. And Broadcom had a 2.4 million bet on the $140 puts for June, which stood out too. And this is longer dated pain priced for the semiconductor market. We also had Meta, PLTR, and HYG, which all showed a bearish skew. This is a full on market de-risking. This isn't even hedging at this point. Now, when we talk about our dark pool levels for the day, we had 586 million in dark pool prints. These weren't nibble orders. They were whale-sized risk-offs. So they're looking to devalue and get rid of some of their risk. Clearly, there's more downside and pain that we are heading into. QQQ had a $420 million print that hit at 12:34 p.m. right as we were breaking new intraday lows, which just gave us more confirmation for more downside. We had LQD, HYG, and TLT, our canaries in the credit market coal mine. We saw size go through, bonds caught a bid, but not because anyone's bullish. It's pure fear rotation at this point. We also flagged a $373 million block pool trade on MU. This was ahead of earnings and deep into a tape-wide sell-off. You don't move size like that unless something's about to break or break down. Now, we saw some stocks also get slapped in today's action. We had Tesla down 3% after leading gains earlier this week. Guess tariffs do matter when you sell cars globally. Amazon and Meta are down 3% each, respectively. Well, 4% for Amazon, 3% for Meta. Consumers broke, and Zuck can't Zuck his way out of tariffs at the end of the day. He's human like the rest of us, folks. Lulu is down 15%, and that was on weak guidance and warning that tariffs are eating margins. They even blamed inflation for people skipping leggings. Yeah, I mean, it's Lululemon. The excuses will never get old. Now, with CoreWeave IPO, that flopped, pricing at $40, dropping below IPO within minutes. Remember when AI was hot? Pepperidge Farm remembers. I can promise you that much. And gold passed $3,100. When tech dumps and macro is hell, gold, that is its time to shine and glow, folks. We also had GME, which was down 25% as well. GameStop wants to raise $1.3 billion to buy Bitcoin, and the market said, yeah, no, we're not supporting that bullshit. So please don't do that. Now, where do we go from here exactly? Powell says inflation is transitory again, but now the Fed is surrounded by fog and can't even see the runway at this point. Policymakers are openly saying they don't know what's next. That's reassuring. It's kind of like when the girl you like says, we'll see where things go. Not very much reassurance going on there, sweetheart. April 2nd is our next catalyst here, folks. Reciprocal tariffs. If Canada, the EU, and Asia hit back, brace for another leg lower. I'm buying puts Monday morning, by the way. So just a heads up, I'm buying puts. 530s, baby. Meanwhile, earnings season is around the corner, and everyone's quietly lowering guidance. UBS and Barclays slashed their S&P 500 target this week. UBS sees 6,400 now versus 6,600. And Barclays bumped it all the way down to 5,900. And spoiler alert, we're at 5,580. So you can go ahead and do the math there. So this isn't a dip, folks. This is just a full-blown correction at this point. It's the market realizing with tariffs, sticky inflation, and failing consumer confidence, this is a cocktail you don't want to sip. We've got dark pool outlaws, heavy put flow, and gold breaking records, and GDP projections falling into the negative territory. That's not noise. That's the market screaming for help. Absolutely screaming. Anyways, hit that like button if you enjoyed this pain. Subscribe if you enjoy chaos, and let me know in the comments if you're buying the dip or shorting everything into the ground. Stay hedged, stay cynical, and I will catch you guys in the next episode. Love you all. Happy Friday. Mwah.